This is Antoine Harris with Platinum Bridge Wealth Strategies, and as we approach the election in November, many people have been concerned about potential market volatility during an election year. So I wanted to give you some information, a historical perspective. As we look back to 1928, there have been 23 election cycles. The markets have been up 19 of 23 times. There have been 4 instances where the markets have been down, and typically they're down due to other events that have nothing to do at all with the election. So in 1932, we were still deep in the throes of the Great Depression. In 1940, we were dealing with the onset of World War II. In 2000, we were in the midst of a tech bubble, a tech wreck, which tanked the markets. And in 2008, we were dealing with the financial crisis. On average, the S&P 500 has been up over 11% during an election year. So regardless of your political affiliation or your views on the candidates, the data do not show that this election year will ruin your portfolio. Now here's some interesting data. This shows what's happened historically going back to 1928 when a Democrat is elected president, in the election year, in the ensuing inaugural year, and the same thing for a Republican when they're elected president. So what we've seen historically is that typically the market expects that if a Democrat's elected president, then some of their policies may not be pro-business, not as favorable for the market. So we'll see a little more muted return in the election year, but it ends up being not as quote-unquote bad as everyone thought, and because expectations were lower, the markets tend to do better going forward. Now the opposites for when Republicans are in office. Typically when a Republican is elected, they're promising many pro-business policies, but in reality, some of those pro-business policies may not come to fruition, and then we're seeing a more muted return in the inaugural year. So the election year is typically better for Republicans when they're elected. The inaugural year is typically better for Democrats. These are just tidbit data. I find it interesting. Net, the markets are typically up during an election year and an inaugural year. The markets have a very strong upward bias in general. Over 70% of the time, the stock market is up. So these data are not surprising. The most important things to focus on are: 1, what's happening with the global economy, the continued growth of the global economy. Secondly, what's happening with valuations domestically and internationally. And third, what's happening with the Fed. So as long as the Fed remains accommodative, that's a huge catalyst for these markets. If we start to see inflation, that could force the Fed's hand to raise interest rates, which could slow things down and promote more long-term volatility. Our focus is really on what our game plan is. So I preemptively added things to the portfolio to account for different market scenarios. If you have any specific questions, please don't hesitate to call. This is Antoine Harris with Platinum Bridge Wealth Strategies, and I'll talk to you soon.